On January 10, 2000, in a theater in New York, Steve Case, 41 years old, the man who had built the largest internet company on Earth, stood next to Jerry Levin, 61, the man who ran the largest traditional media empire on the planet. Together they announced the biggest corporate merger in American history, $165 billion, roughly $182 billion once debt was factored in. A combined company worth an estimated $350 billion on paper. Reporters applauded. Wall Street celebrated. Case called it the defining transaction of the internet age. Levin promised it would fundamentally change how people got their information and their entertainment. 3 years later, the company they built together reported $98.7 billion in losses for a single year, the largest annual corporate loss in American history at that point. Ted Turner, the man who had built CNN and was the deal's largest individual shareholder, would later call it the single biggest mistake of his business career and point out that he hadn't even been the one who made the call. He'd lose roughly $8 billion of his own fortune in the collapse, about 80% of everything he owned. The easy story is that AOL Time Warner died because the dot-com bubble burst. That's true as far as it goes, but it's not the reason this deal became a catastrophe, rather than an ordinary market correction. Plenty of internet-era companies survived the same crash without losing 99% of their value in 3 years. AOL bought the biggest media empire in the world, using money that didn't actually exist, and the war between two incompatible corporate cultures that followed destroyed both halves of the company from the inside, before any outside competitor ever had to lift a finger. 4 separate decisions made that outcome possible, each one traceable to a specific date, a specific document, or a specific number in a regulatory filing. None of them involve a stock market crash nobody could have predicted. All 4 were choices made by named executives at documented moments, and each one is covered in the 4 blocks that follow. To understand why 2 of the most powerful executives in America agreed to merge their companies over a single dinner, it helps to see what each of them was actually worried about going into the fall of 1999. AOL had spent the 1990s building the company that defined the American public's first experience of the internet. We made dial-up modems, mailed floppy disks and CDs by the millions, and a distinctive digital voice announcing new mail. By 1999, it had 30 million subscribers, revenue growing 20% a year, and a stock price that had made it, on paper, worth more than Boeing and Ford combined. Steve Case was treated as a visionary before Silicon Valley had fully become the cultural shorthand it is today. But underneath the stock price was a real vulnerability. AOL sold access to a technology, dial-up internet, that was already showing its age, and it had almost no content of its own to keep people on the platform once faster competitors arrived. Time Warner had the opposite problem. It was, by any measure, the largest media conglomerate on Earth. CNN, HBO, Warner Brothers, Time Magazine, Warner Music, DC Comics, and cable lines running into 13 million American homes. Jerry Levin ran an empire that controlled how tens of millions of people got their news and entertainment. What he didn't have was an internet strategy. The world was visibly moving online, and Time Warner, for all its content and infrastructure, had no coherent plan for what that meant for its business, and no obvious internal candidate positioned to build one from scratch. Every major media company in America was asking some version of the same question in 1999. Does the internet make us more valuable by giving us a new way to reach audiences, or does it make us obsolete by letting audiences reach content directly without paying for cable or a magazine subscription at all? Levin, like most of his peers, didn't have a confident answer. That's the setup for the dinner that changed both companies. In October 1999, Case and Levin met in Manhattan. One man had a soaring stock price and almost no content. The other had every kind of content imaginable and no digital strategy. On paper, it looked like the 2 problems canceled each other out. A tidy, made-for-a-press release symmetry that skipped past the harder question, of whether the two organizations could actually function as one. The two men shook hands on a deal before any serious due diligence had been done. No independent verification of what either company's assets or projections were actually worth. No real stress test of what would happen if AOL's stock stopped soaring. 90 days later, on January 10, 2000, the largest merger in corporate history was signed, sealed, and announced to the world. The deal was structured almost entirely in AOL stock, the currency that had made Case's company look, on paper, worth more than most of the industrial giants of the 20th century combined. That detail, treated at the time as a footnote to a triumphant announcement, turned out to be the first of 4 separate failures that would each, on their own, have been survivable. Together, they weren't. The deal still had to clear regulators before any of that mattered. The Federal Trade Commission spent almost a year reviewing the transaction before approving it in December 2000, and the merger officially closed the following month, in January 2001. That gap between announcement and closing, a full year, is itself part of the story. It was a year in which the Nasdaq kept falling, AOL's stock kept losing value, and the currency funding, the entire deal, kept shrinking, before either company had integrated a single department. By the time regulators had finished asking whether the merger was fair to competitors and consumers, the more urgent question, whether the deal even still made financial sense on the terms it had been signed under, had already started to answer itself. Regulators, by design, evaluate market competition and consumer harm. Nothing in that review process was built to ask whether the two companies could actually function as one, or whether the currency underwriting the entire transaction still held the value it had on announcement day. AOL did not buy Time Warner with cash. It couldn't have. No company in history had that much cash sitting in a bank account. It bought Time Warner with stock, shares in AOL itself, valued at the moment of the announcement at roughly $163 billion, more on paper than HBO, CNN, Warner Brothers, and Time Incorporated were worth combined. That number wasn't a measure of AOL's actual assets, its earnings, or its infrastructure. It was a measure of how high the dot-com bubble had inflated internet stocks by January of 2000, and AOL's stock was one of the most inflated of all. Jerry Levin agreed to accept that currency without what's known in deal-making as a collar, a contractual protection that would have adjusted the terms of the merger if AOL's stock price fell significantly before the deal closed. Without a collar, Time Warner's shareholders were making a direct bet that AOL's sky-high valuation would hold. It didn't. The Nasdaq hit its all-time historical peak just 3 days after the merger was announced and started falling almost immediately afterward. By the time the deal actually closed, in January 2001, the AOL stock funding the entire transaction had already lost roughly 30% of its value. It kept falling from there. Think about what that means in practical terms. Time Warner's shareholders had agreed to sell CNN, HBO, Warner Brothers, and one of the largest cable networks in the country in exchange for a pile of paper currency that was already worth a third less than it had been on the day they signed. And unlike an actual currency backed by a government or a central bank, there was no mechanism to stabilize it. AOL's stock price was a reflection of investor sentiment about an unproven internet business model, and that sentiment was about to change faster than almost anyone in the room that January expected. It's worth asking why Time Warner's own board approved a deal this large without demanding the kind of downside protection any experienced deal-maker would normally insist on. Part of the answer is cultural. By late 1999, internet stocks had been climbing for so long that betting against the trend continuing felt, to a lot of otherwise cautious executives, like the riskier position to take. Skepticism about AOL's valuation would have meant publicly doubting the single dominant narrative of the entire American stock market at that moment. Few boards in early 2000 were built to withstand that kind of institutional pressure to say yes. This is the first of the 4 failures, and it's the one that made every subsequent failure more dangerous than it would otherwise have been. A merger funded with real, stable capital can survive some operational turbulence while the 2 companies work out their differences. A merger funded with rapidly depreciating paper currency has no such cushion. Every month of internal dysfunction was also a month of the underlying currency losing more value, tightening the timeline for anyone hoping to fix what came next. It helps to remember what the broader market looked like in early 2000, because AOL's stock wasn't an isolated anomaly. It was one of the more extreme examples of a pattern playing out across hundreds of internet companies at the same time. The Nasdaq had roughly tripled in value over the preceding 2 years, driven largely by companies with growing user numbers and little or no profit, valued on the promise of future dominance rather than present-day earnings. AOL, unlike most of those companies, actually had real revenue and millions of paying subscribers, which made its stock look, by the standards of the moment, relatively conservative. That perception of relative safety is likely part of why Time Warner's leadership felt comfortable accepting it as currency without additional protection. But it didn't turn out to matter that AOL's fundamentals were stronger than a typical .com's. When the bubble broke, it broke across the board, and AOL's stock fell with everything else built on the same speculative foundation, regardless of how much real revenue sat underneath it. To put the mechanism in plain terms, a collar is simply a contractual promise that if the buyer's stock total falls below a certain price before the deal closes, the number of shares handed over gets adjusted so the seller still receives roughly the value they originally agreed to. It's a standard tool precisely because stock prices move and deals take months to close. Time Warner's leadership chose to forego that protection on the largest transaction in corporate history, at the exact top of one of the most extreme asset bubbles of the 20th century. Whether that was overconfidence, poor negotiating leverage, or simple faith that the internet boom had further to run, the absence of a collar meant Time Warner's shareholders bore the entire risk of AOL's stock falling, with no contractual mechanism to soften the blow. But even with the stock falling, the deal wasn't necessarily doomed. If the integration between the 2 companies had actually worked, if AOL and Time Warner had functioned as one company instead of 2, there was still a path to making the math work eventually. A shrinking currency is a serious problem, but not necessarily a fatal one, if the underlying businesses being combined are actually operating as a single, more efficient whole and generating new value fast enough to offset the loss. The real question heading into 2001 was who was actually in charge of making that integration happen, and the honest answer turned out to be no one. To avoid what would have looked like one company swallowing the other, AOL and Time Warner announced their deal as a merger of equals. Companies choose that framing for real reasons. It protects the pride and negotiating position of the smaller or less dominant side. It can smooth over cultural friction during announcement week, and it avoids the appearance of a hostile absorption that might spook employees or business partners on either side. In practice on this deal, it meant building a leadership structure with almost no clear chain of command. 2 co-chief operating officers were installed, one from each side, Bob Pittman representing AOL, Richard Parsons representing Time Warner, both reporting up to Levin as CEO, with Case installed as chairman. On paper, it looked balanced. In practice, it meant that no single executive had the unambiguous authority to force either side of the company to cooperate with the other. The heads of Time Warner's individual divisions, CNN, HBO, Warner Brothers, Warner Music, understood exactly what that power vacuum meant, and they acted accordingly. Each division had run its own profit and loss statement, its own culture, and its own agenda for decades before AOL ever showed up, and none of them needed AOL's cooperation to keep functioning. When AOL proposed using Time Warner's cable network to distribute broadband internet, The cable executives simply refused. When AOL tried to arrange cross-promotion with CNN's and HBO's content, the producers on the other end of the call sent junior staff to the meetings or sent no one at all. This wasn't disorganization in the ordinary sense. It was a rational response by division heads who had every incentive to protect their own turf and none to help a struggling sister division whose leadership couldn't actually compel their cooperation. A merger of equals sounds, on paper, like a partnership built on mutual respect. In practice at this scale, it functioned as a structure with no referee, and every division inside Time Warner had already worked out that the safest move was to simply wait the AOL side out. Consider the position of a division head running CNN or HBO in this period. Their unit was profitable, well-run, and had built its reputation over decades without any help from AOL. Cooperating fully with the integration meant real costs, sharing subscriber data, coordinating marketing calendars, potentially diverting resources toward AOL's priorities in exchange for benefits from a partner whose own core product was visibly losing value by the month. From inside any individual division, slow-walking the integration wasn't sabotage. It was simply the obviously rational choice, repeated independently by nearly every division head across the company, which is exactly how a merger of equals turns into a company that can't act as one. Multiply that calculation across a dozen major divisions, each reaching the same conclusion independently, and what looks from the outside like organized resistance was really just dozens of separate, individually reasonable decisions adding up to complete institutional paralysis. The paralysis wasn't limited to boardroom politics either. It meant that the integration synergies the deal had been sold on, roughly $400 million in new combined revenue and $600 million in cost savings, close to $1 billion in promised value, never had a real chance to materialize because materializing them required exactly the kind of cross-division cooperation that the governance structure had made almost impossible to compel. Promised synergies of nearly $1 billion ultimately came in at close to zero. It's worth being specific about how a promise that large simply evaporates, because it didn't happen through any single dramatic confrontation. It happened in dozens of small, unremarkable refusals, a cable division that wouldn't prioritize AOL's broadband rollout over its own existing plans, a magazine unit that wouldn't share subscriber data, a music label that wouldn't coordinate a marketing calendar. None of these refusals made headlines on their own. Added together, over 2 years, they were the entire promised value of the merger, quietly declining to show up. The company was at war with itself, division by division, while its founding currency kept losing value in the background. But something worse than internal gridlock was happening in the shadows at the same time, largely invisible to the outside world at that point. While executives fought over territory and authority, someone inside the company was quietly making the underlying numbers look healthier than they actually were. Before the deal even closed, AOL had been inflating its advertising revenue through a mechanism now generally described as round-trip transactions. The structure worked like this. AOL would lend money, directly or indirectly, to struggling .com companies and other business partners. Those companies would then use that same money to buy advertising from AOL. On the books, the transaction looked like real, independent revenue coming in from a paying customer. In substance, it was the same dollar leaving AOL and coming back to AOL, dressed up as a sale. When this pattern came to light in 2002, roughly $500 million in previously reported advertising revenue had to be restated. The Securities and Exchange Commission opened a formal investigation. Time Warner ultimately paid $510 million between 2004 and 2005 to settle the resulting cases with the SEC and the Department of Justice. The fraud itself didn't single-handedly bring the company down. The numbers involved, while large in absolute terms, were a fraction of the total value destroyed by this point. But it confirmed something that a lot of people inside and outside the company had already started to suspect. Some of the financial performance that had justified the largest merger in corporate history had been, in part, manufactured. The mechanics matter here because they explain why round-trip revenue is so effective at disguising a slowing business, and so damaging once discovered. In a normal ad sale, a healthy, independent business decides AOL's audience is worth paying for. In a round-trip deal, the customer only had the money to pay because AOL supplied it in the first place, meaning the revenue AOL reported wasn't evidence of external demand for its advertising product at all. It was evidence that AOL could move money in a circle and call the result a sale. At exactly the moment investors most needed real signals about whether AOL's core advertising business was healthy, heading into and immediately after the biggest merger in corporate history, the company had been quietly supplying fake ones instead. It also raises a question this video can't fully answer because the public record doesn't settle it cleanly. How much did Jerry Levin, the man who had just accepted a currency built on a bubble and then presided over a company tearing itself apart internally, actually know about how AOL's advertising numbers were being generated before the deal closed? What's documented is the outcome, the restatement, the investigation, the settlement, not a definitive account of who knew what and when. What is documented and worth stating plainly is the timing. The round-trip transactions that inflated AOL's advertising revenue were happening before the merger closed, meaning the fabricated numbers were part of what Time Warner's shareholders were evaluating, however imperfectly, when they agreed to accept AOL stock without a collar in the first place. A currency that was already overvalued because of a market-wide bubble was, on top of that, propped up in part by revenue that didn't reflect real underlying demand. Two separate problems with the same underlying currency, discovered years apart, both pointing the same direction, toward a company whose actual worth, at the moment of the merger, was considerably less than the number printed on the press release. With leadership paralyzed, the fraud exposed, and .com advertisers disappearing from AOL's client list as the bubble finished collapsing around them, there was still, in theory, one card left to play: broadband. If AOL could get its members onto high-speed internet through Time Warner's own cable network, the company might still find its way to relevance in the internet's next chapter. The problem was that Time Warner Cable was, by this point, the single division inside the company least interested in making that happen. It's worth pausing on the sequence here, because the order these four failures arrived in matters. By mid-2002, the company was already dealing with three compounding problems at once: a collapsed currency, a paralyzed org chart, and a federal fraud investigation. A healthier company, hit with any single one of those problems in isolation, would have had room to maneuver. AOL Time Warner was being asked to solve all three simultaneously, with a shrinking pool of goodwill from investors, employees, and regulators alike, while the fourth problem, the broadband bet that wasn't going to pay off, was still building in the background, largely unaddressed. The entire merger had been built on a single premise: AOL dominated the internet, Time Warner dominated content, and together the two would be unstoppable in the coming era of digital convergence. The premise had one fatal flaw. The internet AOL dominated was dial-up, and dial-up was already dying. In 2000, only about 3% of American households had broadband internet access. 5 years later, broadband was the majority. That's not a slow, ambiguous trend line that would have been hard to spot in real time. It's one of the sharpest technology adoption curves in modern consumer history, and AOL's entire business, the millions of subscribers, the mailed CDs, the familiar sign-on sound, was built on the technology sitting on the wrong side of it, visible on the horizon before the ink on the merger agreement was even dry. The irony is specific and almost too clean. The one asset inside the newly combined company that could have solved AOL's broadband problem was Time Warner Cable, sitting right there in the same corporate family, and Time Warner Cable, as established in the previous block, was the division that had resisted cooperating with AOL from day one. The company had spent $165 billion buying what looked, at the moment of purchase, like the future of media and technology combined. It had, in practice, bought a media empire and a technology platform that were both about to be overtaken. One by a governance structure that prevented it from helping itself, the other by an infrastructure shift. It had no real plan to survive. There's a version of this failure that's almost purely about timing rather than judgment. AOL's leadership wasn't wrong that owning both content and a broadband pipeline would matter in the coming decade. That instinct was, again, the same instinct AT&T would act on nearly 2 decades later. What AOL's leadership got wrong was assuming the company already had, or could quickly build, the internal cooperation needed to actually pair those two assets together. The broadband future arrived roughly on schedule. The company just never built the internal machinery capable of meeting it. Put the 4 failures side by side, and the pattern becomes hard to miss. A currency that lost value before the deal even closed. A governance structure that made cooperation between the two halves nearly impossible. A set of financial numbers that turned out to be partly fabricated, and a core technology bet that the company's own sister division was actively positioned to undermine. None of these problems were hidden from view by 2002. Wall Street analysts, business journalists, and Time Warner's own division heads could all see pieces of it. What nobody inside the company had done yet was add all 4 pieces together into a single number that made the scale of the damage impossible to argue with. It's worth noting how differently each of the 4 failures would have looked in isolation. A company that overpaid with inflated stock but had strong internal cooperation could have grown its way out of the mismatch over time. A company with a messy governance structure but an honest set of books could have eventually forced a leadership change and fixed the org chart. A company that discovered accounting problems but had a genuinely dominant technology position could have absorbed the fine and moved forward from a position of strength. AOL Time Warner had none of those escape routes available, because each failure was actively closing off the paths the others might have used to recover. If a story like this one, built entirely from public filings, court records, and disclosed financial statements, is the kind of thing you want delivered every week, subscribing is the easiest way to make sure you don't miss the next one. We publish a new documented business collapse on a regular schedule, back to January 2003. By the time the company reported its 2002 results, 4 separate failures had compounded on top of each other for 2 full years. A merger currency that had lost most of its value before the ink dried. A governance structure that made real integration impossible. A fraud that confirmed the numbers behind the deal couldn't be fully trusted. And a core technology bet that had already been overtaken by the market it was supposed to dominate. None of these problems were secret by January 2003. What arrived that month was simply the number that made all 4 of them impossible to ignore any longer. In January 2003, AOL Time Warner reported its full results for 2002, a net loss of $98.7 billion in a single year. It remains to this day one of the largest annual corporate losses ever recorded in American history, and at the time, it was the largest by a wide margin. The mechanism behind that number is worth spelling out clearly, because it's not simply that the company had a bad year of sales. When AOL and Time Warner merged, the deal recorded roughly $99 billion in goodwill on the combined company's balance sheet, an accounting figure representing the premium the company had paid above the hard, measurable value of Time Warner's physical and financial assets, justified at the time by the promise of everything the merger was supposed to become. By January 2003, the company was legally required to acknowledge that the promise behind that $99 billion had not materialized, and it wrote nearly the entire figure off in a single accounting entry. In one line on a financial statement, the largest merger in corporate history became, up to that point, the largest single destruction of value in corporate history. Roughly $200 billion in combined market capitalization, gone in 3 years, counting from the day of the original announcement. Ted Turner had personally lost about $8 billion, roughly 80% of his entire personal fortune, tied up in AOL Time Warner stock as the company's largest individual shareholder. It was in the aftermath of this number that Turner made the remark that would follow the deal into the history books, that it was the single worst mistake of his business career and that he hadn't even been the one who made the decision to do it. Steve Case was forced out of the chairmanship later that year, ending his formal involvement in the company he had built from a single dial-up service into what had briefly been the most valuable media company on Earth. The company removed AOL from its own name, a corporate rebrand that was, in its own quiet way, as clear an admission of failure as the write-down itself. The company that had once put AOL first in its name, ahead of Time and Warner both, decided within 3 years that the letters were no longer worth keeping visible. It's worth pausing on just how unusual a $99 billion goodwill write-down actually is. Even among corporate disasters, goodwill write-downs happen regularly in corporate America. Companies overpay for acquisitions all the time, in small and moderate amounts, and quietly adjust the number down a few years later without anyone outside the finance department noticing. What made this one historic wasn't the existence of a write-down, it was the size of it relative to the entire transaction. The company was admitting that essentially the entire premium it had paid to acquire Time Warner, the difference between what Time Warner's hard assets were worth and what AOL had actually paid for the company, had been an error, evaporated in barely 2 years. Every one of the 4 failures in this video was on its own survivable. Plenty of mergers get funded with volatile stock and recover once the market stabilizes. Plenty of large companies operate with messy, divided leadership and muddle through. Plenty of companies discover accounting irregularities, restate their numbers, pay a fine, and move on. Plenty of companies place a wrong bet on which technology will win and adjust. What made AOL Time Warner the case study it became wasn't any single one of these 4 failures. It was that all 4 compounded on top of each other inside a company with almost no time to correct course, because the very currency that had funded the deal was evaporating in the background the entire time any of the other 3 problems might have been fixed. There's a version of counting the damage that makes the scale even clearer. $165 billion was the announced value of the deal in January 2000. Roughly $200 billion in combined market capitalization had been destroyed by the time the write-down was recorded in January 2003. That means the total value lost wasn't just the premium AOL had paid for Time Warner. It exceeded the entire announced size of the deal itself. Investors didn't just lose the markup, they lost more than the whole transaction had ever been worth, because the same forces destroying the deal's internal logic were simultaneously destroying the value of the underlying companies on the open market. Scale that against what a healthy acquisition is supposed to look like. A well-executed $165 billion merger doesn't need to destroy more than its own announced value to be considered a disappointment. A merger that simply failed to generate the promised synergies, without any of the other 3 failures in this video, might have cost investors a fraction of that number and still been written up as a cautionary tale. AOL Time Warner didn't just fail to create value, it became one of the most efficient value destruction machines in the history of American business, precisely because 4 independent failure modes were all running at full speed inside the same company at the same time. What was left of the company spent most of the next decade being taken apart. In 2009, AOL was formally spun off as its own independent company again, 9 years after the merger that was supposed to make it the center of a media empire. In 2015, Verizon bought AOL outright for $4.4 billion, roughly 3% of what AOL alone had been valued at during the merger announcement 15 years earlier. Time Warner continued on its own until 2018, when AT&T bought it for $85 billion to form Warner Media, built on essentially the same thesis case and Levin had pitched in January 2000. that content and distribution needed to be combined to compete in the digital era. The thesis, it turned out, had been right all along. The execution and the timing had not. That distinction is worth sitting with because it's the part of this story that a simple, "the deal was a disaster" narrative tends to flatten. Combining a content company with a distribution company was not in itself a bad idea. AT&T's willingness to pay $85 billion for Time Warner alone, 18 years later, is direct evidence that serious, sophisticated investors still believed in the underlying logic, even after watching the first attempt fail this badly. What killed AOL Time Warner wasn't the strategic premise. It was the currency used to fund it, the governance structure that prevented it from executing, the fabricated numbers that undermined trust in it, and the specific technology bet that turned out to be already obsolete. 4 operational and structural failures layered on top of a strategically sound idea. The journalist Nina Monk spent years documenting this deal in detail for her book on the subject, and the title she chose for it captures the whole story in 3 words: fools rush in, not villains. Not a single dramatic act of fraud that toppled an empire in one blow, though the fraud was real and it mattered. 2 experienced, respected executives at the peak of their careers rushed into the largest transaction in corporate history, without the safeguards that any one of them would have insisted on for a deal a tenth the size. That's the pattern worth carrying out of this video and into the next one. The biggest corporate disasters rarely come from someone doing something no one saw coming. They tend to come from experienced people skipping steps they already knew mattered because the deal in front of them felt too big, too obvious, or too urgent to slow down for. Case and Levin both knew what due diligence was for. Neither of them insisted on enough of it before shaking hands in a Manhattan restaurant in October 1999. 3 lessons sit underneath this story, each one directly traceable to one of the 4 failures already covered. Never pay for an acquisition, primarily in bubble-inflated stock, without protection against that stock losing value. When you buy something with an overvalued currency and no collar to guard against a decline, you are betting that the peak holds, and peaks, by definition, do not hold indefinitely. A merger of equals is a governance trap disguised as diplomacy. 2 leaders with no clear hierarchy don't build one company. They build a Cold War, and every division underneath them learns to exploit the gap. And the technology meant to save you cannot be controlled by people who have every incentive to see you fail. AOL's broadband survival plan depended entirely on a sister division that had resisted cooperating with AOL from the very first meeting. Go back to that theater in New York on January 10, 2000. Case and Levin stood on stage and promised the future. The future they promised did eventually arrive, a company combining content and distribution at national scale. But it took 18 years, a different company's balance sheet, and the complete dismantling of the empire the 2 of them had built together to get there. Neither Case nor Levin was still in a position of power at either company by the time that vision was finally realized by someone else, and neither of them was around to see it come apart again either. It's worth remembering that Warner Media itself didn't last either. AT&T spun the business back out and merged it with Discovery in April 2022, forming Warner Bros. Discovery and formally unwinding its $85 billion purchase of Time Warner. A reminder that even the correct version of the content and distribution thesis has continued to be a difficult one to execute cleanly, decades after Case and Levin first bet everything on it. The idea keeps proving durable. The execution keeps proving to be the hard part at nearly every company that has tried it since. AOL wasn't destroyed by the internet. It was destroyed by the arrogance of believing you can buy the future with paper money, and by an internal war that made sure no one survived long enough to learn the lesson while it still mattered. If you want to understand how the biggest corporate mistakes in history actually happen, decision by decision, you're in the right place. Subscribe for a new documented business autopsy every week. The next one is already in the works.